Yes, I mean, there's no question that the minutes are pointing towards a tightening from the Fed sometime in the second half of the year, whilst of course some people are going for a tightening as early as the Northern Hemisphere summer, sometime in early July or even August. I think more likely the tightening is going to come in the end of the third or the early fourth quarter, and of course markets are not priced for that yet. There is a risk of backfiring. Of course, many of the Japanese population are very unhappy already with some of the measurements being put in place by the Abe government. However, I think on balance there will be enough voters to support him being re-elected, and a stronger stimulus package to be implemented, even stronger than the one we see now, provided voters believe that the VAT hike will be pushed back the 18 months as the Abe government has suggested. Absolutely. Wherever there's a consumption-led pattern of growth, and India, as you mentioned, is one of the key aspects, that's where there should be foreign investment. In other parts of the emerging markets, however, many of those are reliant upon a cost of US dollar funding. And of course, as the Fed begins to lift interest rates, that cost of dollar funding will rise, and that will squeeze investment into many emerging markets. So unless there's a good organic or intrinsic story in some of those markets, I think many emerging markets in 2015 will probably be hurt quite badly. Without question, the country we're most worried about is Italy. There is obviously very significant debt and fiscal problems on the financial side, and there are very significant consumption and investment problems on the real economy side. And with those twin problems, both bearing down on policymakers, it is going to be very, very difficult for Italy to remain a member of the Eurozone unless there are some very, very significant structural reforms in Italy, and of course those structural reforms do not look like occurring at the moment.